generate consistent income using options. This is our trading summit that we have been hosting here for the month of August. Jess has been hosting the first 4 sessions, and I'm here to wrap things up in a bonus session because we have a 5th Thursday for the month of August. And I wanted to wrap this up by showing you how to generate consistent income using credit spreads. Over the past 4 weeks, you've been learning about how to generate income using the wheel strategy, specifically for those of you that have longer term investments in stocks or ETFs, how to sell cash secured puts, how to sell cover calls and generate consistent income using those 2 strategies for, what is arguably where you hold most of your wealth in longer term equity investments. But today we're going to shift our attention here for those shorter term opportunities for your trading account, for your brokerage account, specifically how you can still generate very similar risk profiles to cash secured puts and cover calls without the requirement to own the stock or the desire to own that specific stock using credit spreads. And most importantly, I want to show you the tools that we have recently implemented here at OptionsPlay that allow you to scan for opportunities that provide you with an edge. And we'll discuss what having an edge means during today's session and making sure that you understand how to use the tools within the OptionsPlay platform to actually seek the opportunities that I'll be teaching you from today's session. Now, I see many of you have already chimed into the chat window, telling us where you're joining us from. So welcome. Please, if you're joining us for the first time, feel free to chime into that chat window. Let us know where you're joining from. We have viewers from all over the world. Thank you so much, everyone, for taking the time out of your busy day to join us for this arguably very special session on how to generate income. And for those of you that joined me on our Monday morning sessions, I've been talking about how the current market environment that we're in is extremely timely for these types of strategies. When the market trades sideways, potentially even a little bit more to the downside, you hold long-term investments, capital appreciation is going to be limited. Where you can really add some return to your portfolio are in these income generating strategies. So really timely. We got a little lucky with the planning for this specific topic and the current market conditions that we are in. And I just want to reiterate before we jump into the session that OptionsPlay Education, the sessions that we host every single Thursday, is here to help you become a sustainably and confident trader. Our goal with any of these sessions ultimately is to make sure that you have the tools in order to be profitable in the long run. That's my goal, is to make sure that you understand that what you need to do, what strategies you need to trade, how you need to be thinking about your portfolios in order to reach that point where you can say that you can be confident in your ability to sustainably grow your account. So before we jump into it, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we'll be using as example purposes during our today's session. So we'll be covering a few different things. First thing I want to talk about, what does it take to actually generate consistent income from a specific strategy? What do you need in order to go about doing so? Then I'm going to talk about a simple and forgiving option strategy, which is a credit spread. And this is a session for everyone. I literally mean everyone. No matter whether you're a beginner to options trading, whether you're an experienced options trader, whether you think the markets are going higher, whether you think the markets are going lower, you're going to be able to capture something from today's session where you can walk away with some ideas and know how to start trading these types of strategies. And I simply recommend, no matter what type of experience level you have with options trading, this is the one strategy you should be adding to your toolbox with regards to being able to consistently generate income in your overall portfolio. And in order to help you understand this simple and forgiving strategy, I'm going to go through a live trading example, which happens to also be the daily play from this morning. I found it using the report that I'm going to be showing you later today. And I'm going to walk you through the trade setup that we have during this morning's trading session, or rather today's daily play, and walking you through that trade and helping you understand why this trade had the edge that led me to use it as the daily play. And I'm going to show you how you can find the same report using the same report that I used to find today's daily play, and how you can find trades that also have an edge, and go through all of the examples that the current trading report has. And at the very end, I'll open this up for Q&A. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can I generate consistent income in any market using credit spreads. Now, before we jump into it, I just want to get a quick sense for the audience here. How many of you have traded a credit spread before? I just want to get a sense for how many of you are familiar with it, how many of you are brand new to this strategy. Okay, so it looks like about three quarters of you are familiar with the strategy, have traded it before. About a quarter of you say that you have not traded this before, and a couple of you say you're not sure. Okay, so for those of you that have traded a credit spread before, hopefully this gives you a clear understanding as to what type of credit spreads you should be seeking if you're going to sell a credit spread. And this really lays out in very clear terms what you should be looking for. If you're brand new to credit spreads, what you're going to be able to do today is have a good understanding as to why credit spreads is a strategy that you might want to learn more about and add to your toolbox as far as options trading. And for those of you that are saying you're not sure, I'm guessing that you're probably newer to options. You're not familiar with the term credit spreads. So we'll run through this and make sure you understand what a credit spread is. Okay, so now that we have a pretty good sense for the audience here in the room, 71% of you have traded it, 26% say no, and 3% have said you're not sure. So for those of you that are brand new to these types of credit spreads, you might want to follow along. But one of the things that I do want to make sure everyone understands is that you can get access to the full recordings, the recording of this session and the slides, if you simply have a membership with OptionsPlay or you start your free trial. And you can do it completely free of charge by simply going to optionsplay.com/sign up. Or if you take a few seconds right now, point your phone to that QR code, sign up for a free trial. It takes literally 10 seconds to get started. And what we'll do is we'll send you the recordings and the slides so that you can just pay attention during today's session. You don't have to sit down scribbling notes. We will send you everything that you need after the fact so that you can review it and make sure that you understand it before you implement these types of strategies. Not only will you get the recording and the slides, but you'll also get access to the platform that we'll be showing you during today's session to scan for these types of credit spread opportunities, specifically the ones that have the trading edge, like the ones that I found with our daily play from this morning's session. So if you're brand new to OptionsPlay, you're joining us for the first time, sign up for that free trial because it's going to give you access to a wealth of information, including the slides, the recording, and access to the platform that you'll be able to see that I'll be showing during today's session. So let's jump into it. Let's talk about the simple strategy, vertical spreads. Now, you might be familiar with vertical spreads. You might not have heard of vertical spreads before. So I'm just going to help you break down what a vertical spread is. It's a limited risk strategy that allows you to take a directional view on the market. And the key here is a limited risk strategy, because with all trading strategies, the thing that options allows you to do is control your risk. And this is incredibly important for our traders, especially if you're brand new to options trading, because the only thing that you have control of in the overall market is how much risk you take. You can't control where the market goes. You can't control anything else. The only thing you have control over is how much risk you take, because that's going to help you determine whether or not you can have an opportunity to succeed in trading. Because there's an infinite amount of capital that you can make from trading, but there's only a finite amount of capital that you can risk in order to try to make that return. And what you have to do as a trader is make sure that the finite amount of capital that you have to risk is protected at all times. And the way to do that is either you control the amount that you're risking, or you have limited controls over your risk. And that's exactly what a vertical spread allows you to do. So the nature of the strategy already puts you onto the right path in terms of being a profitable trader. Now, vertical spreads can either be suitable for both mild or large directional views. Whether you have a bullish or bearish outlook, vertical spreads will allow you to trade in both bullish or bearish, but there are different types of vertical spreads, some that are better for if you have a mild directional view, and some that are better if you expect the stock is going to make a really big move. And we're going to talk about what type of what type of market environment credit vertical spreads are suitable for. But the thing that actually a lot of traders may not be familiar with is that vertical spreads, when you trade a multi-leg strategy versus a single leg strategy, such as buying a call or a put option, is that you can actually get better liquidity or better execution quality on vertical spreads, because not only is it a limited risk strategy for you, but it's also a limited risk strategy for the market maker on the other side. It's easier for them to control their risks. When you buy a long call or a long put, the market maker on the other side of that trade is short a call or short a put. That has substantially more risk to them, which is why when they're trading a vertical spread against your long call, the preference is going to be on that vertical spread, because they're going to also be able to control their risk. Remember, the market maker is taking the other side of the trade. They have to offset that risk after they initiate your trade. And the easier it is for them to offset that trade, the more likely they're going to interact with your order and perhaps give you a better fill. So when you're thinking about buying a call or buying a vertical spread, note that there is going to be a difference also in execution quality between the two. Now, when you're trading something super liquid like SPY, you're not going to notice a difference. But when you're trading something a little less liquid, something that's somewhat liquid, there's going to be a difference in terms of liquidity as well between vertical spreads versus buying that single-legged long call or put. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, so let's talk a little bit about growing an options account, because, I think ultimately at the end of the day, while you're here to learn about credit spreads and you want to find out as much as possible, you're doing it because you're trying to grow your options account, right? With any option strategy, with anything that you're learning, whether it's technical analysis, option strategies, risk management, portfolio management, psychology, the end goal of all of it is to help you grow your trading account, and specifically doing it consistently and sustainably. So the reason that I think vertical spreads, specifically credit vertical spreads, belongs in your portfolio to help you achieve your goals of reaching kind of that consistency of growing your trading account is because there are 3 things that you need in order to achieve that. First, you need to be able to gain confidence. And what I mean by that is you need to understand the strategy that you're trading. And what I notice from a lot of, especially traders who may not spend the time to learn about a specific strategy, rather they simply pay someone else, hoping that someone else who's profitable, if you just follow them, somehow you'll also be profitable. I tend to find that almost never works, because you don't understand fundamentally the strategy that they're trading. You're just following someone who tells you that they're doing something. And what you're not learning from it is understanding when it works, when it doesn't work, what it feels like when it doesn't work, to push through it when, and that's really kind of been one of the biggest problems that I see with just simply following someone else, is because you don't truly understand the fundamentals of a strategy. And when you come through a string of losers, what do? You lose faith in the strategy, you cancel the subscription, and you go somewhere else. And that cycle simply repeats itself over and over again. If you can relate to that, please type 2 into the chat window. So what I encourage you to do is to spend a little bit of time, and I'm going to do it in 45 minutes today. I'm going to show you why this one strategy gives you an edge, and I will make sure you understand why that edge and how to find that edge by the end of today's session. So learning how to get a little bit confident in your strategy, so that when you come across a string of losers, you don't just lose faith and jump ship. You continue at it. You know that it's something that you have to continue in order to be profitable in the long run. You have to have confidence in the strategy before you can do that. Number 2, gaining consistency. So I tend to find that by the requirement for profitability is not winning more often than not. A lot of traders, especially when they're starting out, think that if I just win more often, then I'll be profitable in the long run. But winning often has nothing to do with profitability. There are tons and tons of traders that win 60, 70, 80% of their trades, but are still not profitable in the long run because the losses that they have on the few trades that they lose are far exceed the gains that they have in the 60, 70, 80% winners that they have. And again, if you can relate to that, type 3 into the chat window. However, I do find that when you have the choice between winning more often and not winning as often, when you win more often, you tend to just be on a different emotional level and want to work on improving and optimizing your strategy. I've been a trader for a long time, and I prefer some of the strategies that hit home runs. And I don't have to be right all the time. I could be right 50% of the time and still be profitable in the long run. But especially for those of you that are starting out and you're not quite there yet, starting off with a strategy that is profitable more than 50% of the time just gives you that boost of confidence that allows you to kind of spend more time to want to improve and hone your craft. So, credit spreads, and you'll see naturally on its own, will give you trades that win at least 50% of the time. So it's a really good place to start. And the third thing that you need to grow your options account is preventing blowups. You need to have rules and discipline to prevent blowups and losing faith in the strategy. And, I have a whole session dedicated to that alone, which I will be, talking about next month. So please make sure that you join us specifically on that. But I have plenty of videos on YouTube specifically around how to prevent account blowups. And I encourage many of you to take some time and learn more about it. Many of you joined me during the month of July, where I did a whole summit on this very topic. Incredibly important for those of you. And if you have a membership here at OptionsPlay, you have access to that summit. I highly encourage you to take some time and view that. But it's arguably the most important part with regards to your ability to be profitable. So how does credit spreads fit into all of this? Number one, credit spread is an income generating strategy for a mild directional view on a stock or ETF. What do I mean by a mild directional view? It just means that you basically see a trend in the underlying stock. That's it. That's all you need. You don't need to have a belief that the stock is going to be at a certain price by a certain date, which makes it a lot easier, especially for those of you that are newer to options trading or newer to trading in general, where you don't feel as confident in your ability to navigate the markets and know where it's going. But if you can look at a chart and generally say that this chart is trending down, I think it's moving in the lower direction, that's really all you need in order to potentially initiate a credit spread. So you don't have to have a strong directional view. You just have to be able to look at a chart and generally say this stock seems to be trending higher or seems to be trending lower. That is the only requirement, which makes it a lot easier for a lot of traders. The second thing is that it's a forgiving strategy. It has a higher probability of profit, and this is going to help you build confidence. And lastly, it has both limited risk and limited reward. So when you get into a trade, you know exactly how much you can potentially lose and how much you can potentially make, which means that you have no excuse to ever sell a credit spread and on the back of it say, I lost too much money. Because if you lost too much money, that is fully your own fault for trading too many contracts. And I hate to say that, but it is absolutely 100% your own fault if you ever say, hey, I lost too much money on that trade, because you are the only person that can control how many contracts you trade. And that is the truth. And a lot of people don't want to hear it because they'd rather blame someone else who told them to sell the credit spread. But if you lost money, too much money on a credit spread, the only person you can blame is yourself. But the good thing is that you have full control over how many contracts you trade, and you know exactly how much money you can potentially lose before you get into a trade. And that is arguably one of the most important lessons to learn as a trader. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. So I'm going to walk you through a bearish credit spread example. And we're going to come back to this specific example as to show you why I specifically chose it, why it gave me a specific edge, and why it was the daily play, the trading signal that we sent out to our members this morning. So UPS, we found during our sessions last night, looking at the credit spread report, which I'm going to show you here in a few minutes. And there was an opportunity presented to me. And for those of you that are members here at OptionsPlay, you know that we recently took profits on a UPS short. We shorted UPS on the break below 180. We basically traded it down from 180 to 166. It's recently had a little bit of a bounce, and now's an opportunity, in my opinion, to potentially look for further downside in UPS now that we had a bit of a pause and a little bit of a rally here off those lows. So this is really an opportunity for me to sell a credit spread. But like I said, you can look at a chart, you can generally see that the stock has been trending lower for the last month and a half, and that's really a good indication that you could potentially sell a credit spread. So here what I'm doing is I'm going out to the October expiration, and I'm going to sell a 175 call, and that's going to collect me $4.10. Now, for those of you that have joined Jessica's sessions over the past few weeks, this is similar to selling a cover call at the 175 strike and collecting $4.10. However, in this particular case, you don't own the stock. So if you just sold the 175 call, what happens is that you're going to have, number one, unlimited risk. That's not something we want, right? You don't want to have unlimited risk, and you're going to have to put a lot of capital aside in order to execute this trade because you have unlimited risk. Your broker is going to demand that you put up a fair amount of margin in order to sell a naked call option. So we don't want that. What we want to do is we want to limit our risk, and we also want to limit the amount of capital required to get into the trade. So what we're going to do is we're going to buy a 180 call against it, pay $2.04, and the net difference between the two gives me a credit of $2.06. I basically take $4.10, subtract $2.04, and that's going to give me the $2.06 that I'm collecting in terms of income on this specific trade. And what this is going to do is it's going to give me limited risk, and it's going to allow me to collect income. And I'm going to walk you through how this strategy can be potentially profitable and what's going to happen in order for this trade to sustain a loss. But before I do that, there's a few metrics that I think are important for you to understand in order to really confidently understand the strategy. So the first number to understand is the width, which is the distance between the two strike prices that you're buying versus selling. So I'm selling the 175 and I'm buying the 180. That's a distance of $5 apart. Now here I'm collecting $2.06 out of the $5. And an important concept to understand is that whatever I collect in terms of income, the rest of the width is going to be my risk. So in this particular case, when I look at this trade on OptionsPlay, my max reward is $206 because $2.06 multiplied by the 100 shares is $206. That's the most I can make from this strategy. My max risk is going to be the difference between $5 and $2.06. So the difference between $5 and the $2.06, which is in this particular case, $2.94, that's going to be my max risk. So my max risk here, as you can see, is $2.94 or $294 per contract, because whatever I can potentially make on the credit spread, the rest of the $5 is going to be my risk. Reward versus risk is always going to come out of the distance between the two strike prices. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. This is going to be one of the more important concepts that we're going to come back to, okay? The distance between the strike prices and what you can make versus what you can potentially lose. The second metric important to understand is the break-even price, which is the just basically $175 plus the $2.06. I'm selling the $175 call. I have a $2.06 credit that I'm receiving for selling that call option. So when I add those two numbers together, that's going to be my break-even price, $177.06. So basically the stock has to stay below $177.06 in order for me to be profitable. Remember, when I sold this, UPS was trading at 172. I think it's going to go lower, but as long as it stays below 177, I will be profitable. And that is the forgiving nature of this specific strategy. And what we're going to do is we're going to look at the specific outcomes to understand how they perform. So here's a chart here of UPS. And let's say and this is the chart of UPS, and this is the overall trend here. We were looking at the smaller trend here before on our chart. This is a larger chart here. But basically, I'm saying that, now that we've had this decline and a little bit of a rally, I think this is an opportunity for UPS to continue to decline now. So if UPS does decline as I expect it to, or if it just simply stays where it is, no matter what happens, whether it goes a lot further down or stays where it is, as long as it stays below 175, which is the strike price that I sold, I'm going to make my full $206 worth of profit. And that's really interesting because think about it. The stock's currently trading at 172. Whoops, sorry. The stock's currently trading at 172. What that actually means that even if the stock rallies by roughly $3, I'm still going to make my full $206 of profit. There are not many other strategies where you can effectively get the directional view wrong and still make the full maximum profit on that specific trade. But that's the first forgiving nature of a credit spread. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. If it goes in my favor, and as long as it stays below the short strike price, I'm going to make my full profits on that specific trade. Now, let's say in the second scenario, I get the directional view even more wrong. The stock goes somewhere between 175 and that 177.06, my break-even price. So it goes above my strike price, but it stays below my break-even price. Here, I'm still going to make a profit. I'm just going to make less of a profit. If it gets to 177.06, I'm going to make 0 profit. If it gets to 175, I'm going to make a $206 profit. So basically, it's a sliding scale between those two prices. The closer I am to 177.06, the less profit I have. The closer to 175, the more profit I have. So I basically have this buffer. Even if I'm wrong in the directional view, I have this pretty sizable buffer that's going to allow me to continue to be profitable as long as I stay within that range. Okay, so does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Now, if let's say the stock makes even a bigger move here to the upside, it goes above 177.06, but it stays below the 180 strike price, the strike price that I purchased. Now I'm going to experience some loss. Now, but that loss is going to be somewhere between the $0 and $294, the maximum loss that I can potentially experience. And lastly, only if UPS rallies above 180. Basically, I got the directional view wrong. The stock has rallied back to its previous highs. This is really the scenario where I lose the full $294. But even if the stock goes to 200, even if it goes to 1,000, the most I can lose is $294. I have full control over how much I can potentially lose in an adverse move against me. Let's say somehow news comes out that UPS has bought FedEx and they're going to build this new company that's going to compete with Amazon, and the stock shoots up by another 10-20%. Well, you're protected in that case, of the black swan event where you can only lose the maximum loss on that specific trade. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, now that we walk through the different scenarios and you kind of understand a little bit about once you sell a credit spread, where do you make money, where do you lose money? Let's talk a little bit about the credit spread that I had set up and why this is the credit spread that I used. So we have back-tested credit spreads all across the entire spectrum of expiration dates and strike prices. And I saw a couple of comments about 0 days to expiration credit spreads. I do not recommend that you sell 0-day expiration credit spreads on single stock names. You can do it on indices because they have no assignment risk or they're European style, but American style options on stocks or ETFs do not sell 0 days to expiration credit spreads on those because you have a very high likelihood of being assigned at expiration, and many times you might have a credit spread that expires out of the money at the close, but after the close, after hours, the stock moves and you get assigned on it. There's nothing you can do about that. So do not do this on single stock or ETFs, American style options, only if you're going to sell credit spreads on 0 days to expiration, or rather short dated expirations. You can only do those on indices. So we have back tested this across the spectrum on expiration dates and strike prices. And while there are some traders that like to sell 0 days to expiration strategies on this, we have back tested those, and the best performing strategies comes when you're selling these roughly 45 days out and you're selling an at the money call or a put and buying back a 25 delta call or put. So what we're doing is we're selling the strike price that's closest to the current price of the stock. In this particular case, at the time, the closest strike price to 172 that was out of the money is the 175s. And then we bought the 180s because the 180s had a 25 delta strike price. Now, 25 delta 25 delta strike price is referring to a strike price where there's a 25% probability that the stock will be above that price by expiration. So the 180 strike price on this chart is reflecting a strike price where the stock has about a 25% chance that's going to be above that price at expiration. So we always use a delta-based approach, always a probability-based approach to selecting our strike prices. That's how we're going to get more consistency in our trades. So only 25% chance that we will experience a full max loss on each given trade. And that's how you're going to get consistency from trade after trade. And you're not going to get that inconsistency that you might be experiencing if you're picking your strike prices in some other way. But the most important part of all of this from our back testing is not the expiration date and strike price. It's the single requirement of how much income you want to collect on this specific trade, because you might look at another stock. Maybe tomorrow you go to Apple and you say, I think Apple is bullish or bearish, and you set up this type of credit spread that I'm referring to. You don't just sell that credit spread because you've chosen the 45-day, you sold the at the money and bought a 25 delta call or put. There's one requirement that's more important than all of them, which is the fact that you must collect 1/3 of the width, or roughly 33% of the vertical width in income, in order for it to be profitable for you in the long run. I'm going to walk you through why. But before I do that, I just want to make sure everyone understands what I mean by that. The distance between these two strike prices is 175, 180. So you go into if you're doing this manually, you pull up an options chain, you go out 45 days, you sell the at the money, you buy the 25 delta, and you look at how much income that credit spread is collecting. In this particular case, I was collecting $2.06 on a $5 wide credit spread. So $2.06 on a $5 wide credit spread is roughly 40% of the vertical width. It's actually roughly 41% of the vertical width. So that exceeds the 33% minimum. Okay, so on a $5 wide credit spread, you must collect $1.67, $1.66, which is 33% of the $5 that you want to collect. So if you set up a credit spread that's $5 wide and it's only collecting $1.50, $1.40, that is a credit spread that you should stay away from in your that's a trade that you should stay away from. And I'm going to explain why. But before I do that, I just want to make sure everyone understands what I mean by 1/3 of the vertical width, that you must collect that in terms of minimum income on the credit spread. If that makes sense to you, please type 1 into the chat window. Perfect. Okay. Now, I want to explain why this rule is in place and why this is the most important rule when you're selling credit spreads. So, in my example, I sold the 175 call, I bought the 180 call. If, let's say, I was to collect 1/3 of the vertical width, which is 33%, that comes out to be roughly $1.66. And when you sell credit spreads, you're going to come across lots of credit spreads that are roughly $5 wide. So the rule of thumb here is a $5 wide credit spread, you must collect $1.66. Why is this rule so important for you? Because, like I said in the earlier stages, anything that you sell, or anything you collect in terms of income, the rest of it is your potential risk. So if you collect $1.66 in income, you have $3.34 worth of risk. That is a risk reward ratio of roughly 2 to 1. So what that means is that if you have 2 winning trades where you win $1, you have 1 losing trade where you lose $2, you have 2 winning trades where you win $1 each, you have 1 losing trade where you lose $2, and you repeat the cycle over and over again. What do you get at the end of that? Type your answer into the chat window. What do you get at the end of this type of trading strategy where you have 2 winning trades of $1 and 1 losing trade of $2? A big fat zero, zip, exactly. Now, a lot of traders will be asking, why the hell would I want to sell a credit spread where my expected outcome is 0? And my answer to traders who ask me that question is, most traders that are asking me this, most traders that are selling these types of credit spreads are not even at break even. They are unprofitable in the long run. What I'm trying to do is, at the very minimum, make sure you understand what it takes so that you, at the very least, break even on the trade. And that's why this is the minimum requirement. If you collect less than 1/3 of the vertical width, it is quite incredibly difficult in order to be profitable in the long run, because you have to be right on 70% plus of your trades just to get to break even. And that's incredibly hard to do. Even 67% winners is not easy to achieve, but that is the bare minimum that you need to get in order to at least break even and not be unprofitable in the long run. Does that make sense, everyone? Please type 2 into the chat window if that makes sense. Perfect. Okay, so I'm not here to get you to the bare minimum. I'm here to try to get you to profitability, which is why it's important for you to understand the edge. Now remember, in my example, we collected $2.04, or actually it was $2.06, but it doesn't matter here. And on my $5 wide credit spread, I found a credit spread that collected $2.06, which is roughly 41% of the vertical width. Remember, what I can potentially make, the rest of it is what I can potentially make. The rest of it is my risk. So if I can make $2.04 on the credit spread, then my risk is $2.96. That gives me a risk reward ratio actually slightly better than 1.5 to 1. That means if I repeat the same cycle of 2 winning trades of $1 and 1 losing trade of $1.50, and I do this over and over again, what am I going to be able to do? I'm now going to be profitable. And that's why it's so important when you're selling credit spreads to try to find an edge with regards to credit spreads that are going to collect higher than 1/3 of the vertical width. Does that make sense as to why this is an important element of gaining an edge with credit spreads? Please type 3 into the chat window if that makes sense to you. Okay, so that is the piece on the options trading side of how do you gain an edge. It's not too difficult to understand. It takes a little bit of time to wrap your brain around it if you're brand new to this, but once you get it, it's an incredibly simple concept, because the vertical width is what you're playing with, and you're trying to collect as much of that as possible, because if you do that, you're risking less so that you skew the risk reward in your favor. That's one place where you can gain an edge. The second place you can gain an edge is in the trade itself, is in this trading setup itself. What do I mean by that? So here's a chart of XLC, an ETF, and over a period of time in 2020 and 2021, had a pretty big move here to the upside. It was a pretty strong and clear trend to understand and see, meaning you don't have to have a strong understanding of technical analysis or fundamental analysis. If you can look at a chart, you can generally get a sense for the trend. And arguably, you could have sold a credit spread just about any point throughout this entire year and would have been profitable multiple times throughout the year. However, that doesn't mean that there aren't good times and better times, or worse or better times to actually enter that credit spread. What do I mean by that? So if you see this uptrend here, like I said, you could have entered this credit spread at just about any point in this big move. And like I said, as long as you can look at a chart and generally say that it's moving higher, you can sell a credit spread. You can be profitable, right? So even if you sold it arguably at what I would consider some of the worst times, right? Let's say you sold the credit spread right here, right here, right here, right here, right? Would you have been profitable in the trade eventually? Yes, but you would have probably had to sit through quite a bit of chop before the trade ended up being profitable in your favor. If you entered it here, you would have just suffered through a little bit of chop, some losses, initially unrealized losses, before the trade eventually turned back in your favor. As long as you kind of sit through some of that chop, you can be profitable. And with high probability of success strategies, you have that buffer and you have that leeway to sit through some chop and be able to be profitable in the long run, unlike some other strategies. But there are still what we would consider optimal times to enter. So when you've identified a bullish trend, when you wait for a pause or a pullback, those are your best opportunities to enter. So if you entered instead of at any time, you entered specifically at the times where I've pointed out where there are green circles, that's really where you could have been profitable. Within just a couple of trading sessions, you would have been profitable and have been able to get out of the trade much, much quicker and not have to sit through that amount of chop. And that works both on the upside as well as on the downside. And what you're trying to do here is when you're trying to find the best trading setups with regards to credit spreads, you want to find credit spreads that collect that 33% of the vertical width, but you also want to do it on stocks where the trading setup is the best from a timing perspective. That means in a bearish trend, you're looking for some type of consolidation or a rally to sell into, right? That's kind of what we did with UPS. We had a bearish trend, we waited for that rally, and then we put in that trade setup for selling that credit spread. So those are the two primary ways where you can really try to find an edge and put as many things in your favor in order to be profitable with this type of strategy. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Now, that begs the question, how can you find trade setups similar to the one that I had with UPS, where you collect roughly 40% of the vertical width and you have the rally here in the stock that is in a bearish trend? And that's really kind of where our fully automated credit spread report that has now been fully integrated into the OptionsPlay platform comes into play, because it does 3 incredibly important things for you automatically. The first thing it does is it finds credit spreads that generate at least 33% of the vertical width, and many of them will collect 41%, 40% of the vertical width. And those are really the ones that I pay attention to. And those are the ones that I typically trade. There's usually at least a handful of stocks in there that generate roughly 40% of the vertical width, even though we're scanning for any of them that are greater than 33%. The second thing that we do is we look at only very liquid underlying symbols, meaning symbols that we know that you can execute at the midpoint or very close to the midpoint on any of these opportunities. And that is a really incredibly important part, because there are lots of credit spreads that you can sell on stocks that are not liquid, and those are absolutely worthless to you as far as an idea goes. So our tools scan only for opportunities that are in very liquid symbols. That is roughly about 500 optionable symbols in the entire universe of nearly 6,000 optionable symbols. So we're throwing away 90% of symbols just from that alone. And the third thing is we align it to a technical directional view, specifically looking for those rallies in a bearish trend or dips in a bullish trend. That's how we found UPS. And that's what I want to spend a few minutes walking you through our tools here at OptionsPlay that automate this specific tool for you. So you can find the credit spread report on the OptionsPlay platform by going to your ideas section and clicking on the drop-down menu specifically for credit spreads. So you have technical ideas, you have cover calls and short puts, which is what Jessica has been showing you over the past few weeks. And now we have added credit spreads. And this allows you to find all of what used to be in our credit spread report, which was in the hub, that is now fully integrated into the OptionsPlay platform. And what you can see is you can sort it based on different things. So you can look at all credit spreads, you can look at bullish credit spreads, you can look at bearish credit spreads, you can look at whether that something has earnings or not, and you can filter it out. So I've just for this purpose, I'll look at bearish calls. I'll look at both earnings and non-earnings, and I'll filter out anything that's under 35% in terms of vertical width. So I'm only looking at kind of the best scenarios. And let's take a look at what we have here. And what you can see here is these are all the opportunities. These are bearish opportunities. Bearish opportunities that meet the requirements that I'm looking for. And it's sorted for you based on how much premium you can collect. You can sort it based on any number of things, but I always sort it based on how much premium am I collecting. So basically the ones that are collecting the most amount of income are at the top relative to the width of the strategy. So I'm gonna pick some stocks that I think are more commonly tracked, right? Starbucks. I'll use Starbucks just because this is one that I actually have a bearish view on. And as you can see, if you look at a longer term chart here of Starbucks, this is one of those stocks that is trending lower, right? It's into the consumer discretionary sector, which is certainly one of the weaker sectors that we've been talking about. And we recently had a little bit of a rally, right? And if you look at these rallies, those are your opportunities to sell credit spreads. When you have this type of rally, you get a move here to the downside relatively quickly. You have a rally, you have a move here to the downside. You have a rally here. So it doesn't mean that this will end up being profitable, but you're just doing everything you can to try to find setups that have as many things working in your favor as possible. So here, on the Starbucks, if I sold the 98 and bought the 103 for the October 13th expiration, I'm going to collect $1.83 on a $5 wide credit spread. So this is just a little under 40% of the vertical width. Now, this updates once an hour, but this is updated in real time. So you can basically see all the real-time prices before you execute it and click on trade in order to see live prices that you can actually execute this into your account. Now, if you look at Morgan Stanley, I'm just looking at big names because these are ones that everyone, are familiar with. Morgan Stanley, as you can see, similar setup to UPS, had a pretty big decline here over the past month or so. A little bit of a rally here, not a big rally, but the technical indicators have started to generate a sell signal here. So this is an opportunity where we sell the 85.89, which is $4 wide. I'm going to collect $1.72 on a $4 wide credit spread. So let's do the math on that. $1.72 divided by $4. That is 43% of the vertical width that I can collect right now selling this bearish credit spread on Morgan Stanley. Now, what we're trying to do here is make opportunities as simple as possible for you to find, and opportunities that have already been pre-screened for all of the criteria that I use before I sell a credit spread. And UPS was one of the ideas on this screen, which is why I used it as a credit spread or daily play trade for today. For all of our members that received that trade setup this morning, you saw that we were able to enter UPS on the rally and looking for that dip from that UPS trade. And the UPS is down 1.5% here today. We've made a nice profit on that trade already, and we'll likely be able to take profits on that fairly quickly. And that's really kind of the key to selling credit spreads, is you want to get an edge on the credit spread to collect an outsized income on the trade, and you want to have the timing on it set up so that you can collect profits on that relatively quickly. And that's how we found UPS. But you can use this tool to quickly find opportunities. Here's another one on T-Mobile. I don't particularly have a bearish view on T-Mobile. Maybe you do, but this is really where you can kind of take your views and apply it to the trading to the trading opportunities that you see here on the screen. And one of the cool things that we built now is that you can easily sync these credit spread opportunities to either your portfolio or to your watch list. So I can say, just show me the 4 opportunities on stocks that are in my watch list. So here, Lockheed Martin is on my watch list. So it's showed up as a bearish credit spread. Maybe I have a bullish view on it. Maybe I have a bearish view on it. It depends on which watch list it's on. But maybe I'm looking at this and I see Goldman Sachs is on my bearish watch list, and I see that it's now showing up as a bearish credit spread. That might be an opportunity for me to now get into the trade, right? I've been watching this stock for a while, and now it's on a credit spread report. Let me take this opportunity and sell that credit spread here on Goldman Sachs. Or if, let's say, you have stocks in your portfolio, which I don't have any that match the credit spread right now, but if you do, you can easily click on that and see which stocks in your portfolio have generated a bearish or bullish credit spread. And that might be an opportunity for you to either add to that position, close out that position, but it's an incredibly powerful tool to help me scan for opportunities across the stocks that I am paying attention to, stocks in my portfolio and stocks in my watch list. And you can do this same thing for cover calls and cash secured puts. For example, if you have, here are 5 stocks in my portfolio that have opportunities to sell cover calls on, or if I'm looking at my short put report, I have 64 opportunities in my watch list, 3 stocks in my portfolio that I can sell cash secured puts on. So this is really, or rather 2 stocks in my watch list that I can sell cash secured puts on. So this was really designed to try to make this as easy as possible for you to find opportunities, align it to symbols that you care about, or find new opportunities, but do so in a way so that you can click one button and be able to see the trade setup here in OptionsPlay, know exactly how much income you can collect, what's your max risk, what's your max reward, click on the trade button and have this executed into your trading account. We did this so that you can make this really, really simple. So for example, if I'm looking to execute the Starbucks trade, I can basically set up this trade, click on the trade button, and select maybe my credit spread portfolio and add that to my position, to my credit spread portfolio, whatever portfolio you're looking at. And this is an incredibly important part to helping you manage this trade. And a lot of, I saw a few questions on how to manage this particular trade. So let me look at my credit spread portfolio. I can see how much I have in terms of unrealized gains and losses. I'm going to pull up the daily play portfolio actually in 1 second, because we have the UPS trade. So the UPS trade we entered this morning, we're up 21% in that particular trade. That 21% number is what I use to determine whether it's time to take profits, cut losses, or get out of the trade. So the percentage terms, it's really the most important tool in helping you gauge whether it's time to get into, whether it's time to take profits or cut losses. And Jessica reviewed with you last week on the rules for managing a credit spread. I will quickly review that with you guys here. Basically, the rules for managing a credit spread is that if you've made 50% of the max profit, so if this reaches 50%, it's time to start taking profits on your trade. If it loses 100% of the premium that you lost, so if this turns into a negative 100% gain, then it's time to start cutting your losses on that specific trade. So those are the two rules. 50% gain, take profits. 100% loss, start taking loss, or you close out the full position on that specific trade. So I do have a separate session specifically on managing credit spreads, and I do encourage for those of you that are interested to watch that video, because it's incredibly helpful to show you how the OptionsPlay platform portfolio tool helps you view your trades, helps you understand where they currently stand and which ones you need to take profits on and which ones you want to close at a take profit. But the OptionsPlay portfolio tool is incredibly helpful in helping you manage these trades that you find as trading setups under your credit spread opportunities here in OptionsPlay. So with that, that covers what I wanted to share with you here today. I really hope that this is helpful in giving you a better understanding as to how to sell your credit spreads for growing your trading account in the long term. And I hope that for those of you that found this useful, that you are able to utilize this report for your trading setups. And just a reminder, again, if you found this useful and you're finding this opportunity on selling these credit spreads useful for you, you want access to the recording or the slides, you just need to either be a member. If you're a member, you're all set. If you don't have a free trial, you can sign up for a free trial using the QR code on your screen or optionsplay.com/signup. And this will give you access to both the recording and the slides, as well as access to this platform that does the scanning for these opportunities for you. You can look at these opportunities, add them to your portfolio once you execute them, and use the portfolio tool to track your positions and know when it's time to cut your losses and take profits. So quick poll here. Do you feel better informed about selling credit spreads after today's session? Yes, no, or I'm not sure. I'm going to launch this poll. I just want to get a sense for how many of you found this session useful. And please be honest, if you didn't find this very useful, let me know, because, we're certainly we do these sessions for you. I really say thank you every single week to our members for supporting us and allowing us to continue to do this. When you tell us what you like, what you don't like, we take that feedback into our sessions and make sure that we continuously improve and provide you with what you're looking for, because it's you that support us in being able to do this. And again, I thank all of our members every single week for allowing me to continue to do this. Okay, so great. Many of you have found it useful. For the 1% of you that said, you didn't find this useful, for the 7% of you that say you're not sure, please feel free to send us your feedback to info@optionsplay.com. I'm happy to try my best to incorporate any feedback that you guys have on these sessions. Now, before I open this up for Q&A, now, again, sign up using the link here, optionsplay.com/signup, or point your phone to that QR code. I'll leave it up here for one more second so that if you're on your laptop, you can just take a picture of that on your phone. You can sign up for it. It takes 10 seconds to sign up for a free trial, no credit card required, and it gives you access to the platform, the recording, and the slides. And I do want to just remind everyone, this was the bonus session here for August. I'm about to launch the next session here in September. I'm really excited about this. I'll be doing all 4 sessions in September on showing you how to level up your options, basically looking at how to go from trading singles to doubles to trading more complex strategies, learning from step 1, buying calls and puts, selling calls and puts, trading debit spreads, trading credit spreads, trading condors, butterflies, diagonals, complex strategies, kind of how you progress through the system to go from single leg strategies to more advanced strategies. I'll be doing all of that here in September, and you can register using the QR code here on your screen. Point your phone to the QR code. It's a pretty simple sign up form. Just name and email address, and you will be set up for our next trading summit here, kicking off next Thursday at 4:15 p.m. as I normally do every single Thursday. So with that, let's go back to questions. I saw a couple of questions. I know a lot of you have been telling me over the past year or so that you've been missing me on CNBC. I am happy to announce that I've recently reached a new agreement with CNBC to do some different things, but you'll be kind of seeing me back on providing some trading opportunities on CNBC Pro. So really excited to be kind of re-engaging with CNBC on that front. We've been working with Fidelity a lot over the last year or so. So really excited to be back doing some more stuff with CNBC in the next few weeks, actually. So for those of you that are looking for shorter dated expiration, so this is something that we are going to be adding here to the future in regards to selling shorter dated credit spreads. However, I will say, based on our back tests, shorter dated credit spreads have a much, much higher assignment risk. And that is something you want to avoid at all costs. The last thing you want to do when you're selling a credit spread is to be assigned early. You basically want to do everything you can to avoid early assignment. And you can't do that when you're selling shorter dated options. You just have a very elevated early assignment risk in the last 3 weeks to expiration. So if you're selling something that's less than 3 weeks from expiration, at any point you can be assigned early on that. So that's the reason why we suggest that you go out 45 days. When you're selling credit spreads, you don't want to be assigned because you're not, first of all, you may not even have the margin to be assigned on a credit spread. So that's why we don't prefer selling credit spreads that are shorter dated. Vertical spread is also known as a short put spread or bear puts. No, it's not a bear put spread. It's a bull put spread, and a bear call spread is what you would traditionally call a credit spread. If you're a member and you're looking for a previous summit, please just reach out to our customer service team on the OptionsPlay platform. There is a questions ask us button here in the upper right-hand corner. If you simply click on that button, just say, hey, I'm looking for the recordings for the July summit. Can you point me to it? We'll respond to you with those settings, with those recordings. You just have to be either a member or a free trial in order to get access to those recordings. For those of you that are asking why I'm bearish on UPS, if you're a member, you got the full write-up this morning. It's all in that write-up in that trade idea session. So if you got that email, you can see my rationale behind why I'm bearish on UPS. How can I decide to do a bullish or bearish credit spread? Like I said, depends on the direction of the stock. But that's something that our report already scans for you. So, for example, if you look at this consolidated Edison trade idea, that's a bearish trade idea. We're only presenting you bearish trade ideas in a bearish stock. right? So the stock is trending lower. It's had a little bit of a rally off that bottom, and now is an opportunity from a momentum perspective to now enter short. So we've already done the pre-screening for when you might want to do a bearish or bullish credit spread. It depends on the trend of the underlying stock. You can also, align it to your overall trend of the market. So for example, if you think that the market is going to move higher, you might want to skew more towards doing more bullish credit spreads. And when you think the market is skewing towards more bearish, you might try to sell bearish credit spreads. Wayne, thank you for your feedback. I certainly will reach out to Tom Sosnoff and see if we can set up a session on just 0 days to expiration strategies. He's been doing a lot of research on that front. We've been doing a lot of research on this front. So definitely we'll try to have Tom back for the next session on that. Is there a guidance on the width of credit spreads? So yeah, I mean, generally speaking, you're going to find credit spreads, to be within a certain range depending on the price of the stock. Higher price stocks will have a wider range, lower price stocks will have a lower range. But, also the other factor is volatility. The more volatile the stock is, the more likely the wider the strike prices. The less volatile the stock, the less wider the strike. But basically, between 100 and maybe let's say 75 and 150, you're going to have about a $5 wide credit spread. Above 150, you're closer to have a $10 wide credit spread. Above that 250, you're going to have $20 credit spreads. And then below 75, you're like looking at $3-4 in terms of credit spreads, just as a general rule of thumb. Why would you call trading a credit spread with a cash secured put? You would not. The cash secured puts and credit spreads are two completely separate strategies that are not related at all. So can you have a $10 vertical spread at a time? Yeah, absolutely. I'll see if I can find a $10 wide credit spread here. So here's Lockheed Martin, right, which is at $450. This is a $15 wide credit spread on Lockheed Martin because it's a high price stock. Let's see. I'm trying to find a higher price stock. That's probably going. Here's Northrop Grumman, $433 stock. You're selling the 140s, buying the 440s, buying the 455s. So that's a $15 wide credit spread. Raytheon, which is this $86 stock, selling the 87, buying the 90, that's a $3 wide credit spread. So you can kind of get a sense for how wide things are depending on the price of the stock. So BIIB, more volatile, right? So $267 stock, we're selling the 270, buying the 285. So $15 wide credit spread. Goldman Sachs, 330s, selling the 330, buying the 345, another $15 wide credit spread. So you have plenty of ranges of $5, $10, $15, and you can pick based on kind of your risk tolerance and how much risk you can take in your account. Should I let credit spreads expire? You should almost never let a credit spread expire. You should never let a credit spread go into the last 3 weeks to expiration. 2 to 3 weeks is the maximum you should hold a credit spread. Anything, if you're in that last 2 to 3 weeks before expiration, your assignment risk elevates substantially. And again, you don't want to be assigned early on a credit spread. So which is why we always exit a credit spread about 3 weeks out from expiration. Are there any times you close only one of the two legs? In my opinion, I don't think that's worth doing. I know some advanced traders that like doing that. Basically, they do it when a trade is going against them, right? Basically, they get rid of the short leg and they hold on to the long leg. You are adding more risk in order to do that. You're actually many times adding substantially more risk in order to do that. But like I said, that's an advanced strategy. You're adding more risk. I don't love the idea of adding more risk when you've already lost money on a trade, hoping that you're going to be able to recover your losses back. That's usually the recipe for potentially, blowing a big hole in your portfolio. So I'm not a big fan of that. Can you please add Iron Condor? I'll be talking about Iron Condors during my trading summit here in September. So the September 21st session on advanced strategies, I'll be covering Iron Condors. This looks good. Would you please share how you come up with the watch list? I'm not sure which watch list you're referring to. Do you do adjustments? Yes. So for those of you that follow our daily play portfolio, you see that I do a lot of adjustments. And I think that, the value of our daily play trading signals is less so in the ideas themselves and more so in how I actually manage the strategies, how I think about winning trades, how I think about losing trades, what adjustments I make, walking you through that process. That is far more valuable, in my opinion, to what we offer here as an options play member to you than the ideas themselves, right? The ideas like the UPS one, you can find on your own. What takes a lot more time to develop and the skill set that's required to be profitable in trading is not the trade entry, but the trade exit, the management of the trade. What do you do when a trade goes against you? What do you do in a trade that works in your favor? That is what the mark of a profitable trader is, how they go about managing their trades. And we do this every single day where we walk you through the portfolio. We look at which trades need adjustments, which trades need to be cut, which need to be adjusted, where we need to add exposure. That is the most difficult part to learn. And that is what we spent all of July teaching you, some of the concepts and strategies. But I actually show it to you day in and day out through our daily play trading signals. So for those of you that are brand new to options play, I hope that is one of the reasons why you consider subscribing or at least starting your free trial to seeing what makes a difference here. Because we're not here to tell you that we're profitable. As long as you follow us, you'll be profitable as well. That doesn't work. It never works. The only way that you can be profitable in the long run is if you truly understand how to go about doing it yourself. And that's what I'm set out to do, is to make sure that you not only understand the concept and the theories, but I actually show you how to do it day in and day out through the trading signals that we send out. Do the same rules apply to bullish credit spreads? The absolute same rules apply to bullish as they do to bearish credit spreads. There's no difference in terms of the rules. Ashok, my options play is showing a different CS than what your showed is. I'm not sure what you're referring to in terms of different credit spread. So you should be seeing the exact same thing. Markets are closed, prices are exactly the same. You should be seeing the exact same thing. How do you incorporate the strategy checklist when selecting your spread candidates? So you should largely see that the strategy checklist mostly lines up, with the exception of if you're trading against the trend of the stock or trend of the market, right? So, that depends on kind of your comfort level in terms of sometimes taking a more counter trend trade, right? But generally speaking, you're going to find trades that mostly line up with what we're looking to do here. It's really more of a comfort level here for you, and the strategy checklist, is important. However, I put more weight into what we have already built into the credit spread than the strategy checklist. The strategy checklist is important, but I put more weight into the ideas because these ideas have already been pre-screened for all of the criteria that I need to sell a valid credit spread. Is there a best practice slide? So thank you for that feedback. I'll certainly put together a kind of a best practices cheat sheet for credit spreads, and we'll put that together for you guys. How to use IV rank for the best credit spreads. So, IV rank doesn't always help you find the best credit spreads because, the best credit spreads have less to do with the IV rank and more to do with the skew of the option. And IV rank simply doesn't capture skew. And that's kind of one of the reasons that I'm not a big fan of using IV rank all the time. They're useful in certain situations, such as cover calls and cash secured puts, but they're not useful in multi-leg strategies because the multi-leg strategies, you're buying and selling two options, not a single option. So from that perspective, I don't think IV rank is as useful for credit spreads as they are for cover calls and cash secured puts. How is delta determined in the stock? So delta is a pretty standardized calculation, rather it is a calculation that most traders will do. There is no standard calculation, but most calculations are pretty similar. There are different option pricing models that allow you to calculate delta. We use a binomial tree in order to calculate deltas for our strike prices. But, you can do it on any platform. Any platform that you use for trading options will have deltas. So, when you're using the OptionsPlay platform, when you select your strike prices, you'll see the strike price, the premium, and the delta next to it. So the 285 strike price has a 24 delta. That's why we chose that. That's the closest to the 25 delta that we're looking for. But on any strike price or any options chains that you look at, you're going to see delta as a calculation next to the strike price. There's a few of you that are saying, you're from overseas. It's hard for you to catch these sessions live. How do you get the recordings? Send us an email at info@optionsplay.com. If you're a member, we automatically email you after every single session the recordings. And we usually group the recordings from each trading summit together. So you kind of have a single page where you can view all of the recordings all at once. You can download the slides on that page. It's all accessible to you on one page. As long as you're a member, we send that to you every single week right after the sessions. That's true also if you're on a free trial. So if you're on a free trial, you're going to get access to the recordings from us every single week. Are there any strategies that benefit from being assigned early? Never, 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 ever. Being assigned early just means that you have to put up a lot of cash to get into the trade, to basically stay in the trade. You don't want to be assigned early. You basically go from margin requirements of a few $100s to tens of thousands of dollars overnight. You do not want to be assigned early. You want to avoid that at all costs. Are there situations where it makes better sense to hold the credit spread till expiration than close it at 21 days? Yes. So I would say that if, let's say you've made, let's say you have a credit spread and you're at 3 weeks left to expiration and you've already made 80% of the premium, right? That is the only case where you may want to take on the risk of holding it to expiration and try to make the other 20%. Basically the trade has worked in your favor. You think that the risk of it going back against you is pretty low. Your early assignment risk in that particular case is virtually zero. That is one of the few cases where you could hold it to expiration. Can this strategy work for brokers where the commission fees are rather high? It's certainly more difficult. But that's really why you want to collect as much income as possible to offset, perhaps higher commissions. You might want to only sell credit spreads that are at least 40% of the vertical width to offset kind of your higher commissions. But higher commissions certainly is always going to be a concern. I would suggest that if you're trading with a higher commission brokerage, to consider one of the lower commission brokerage firms. Commissions are very close to zero across the board, almost everywhere. Moving to a lower commission broker, such as Interactive Brokers, if you're overseas, may be a better solution. Okay, with that covers what I have time for here today. I hope that this was helpful for those of you who are looking to get started with selling credit spreads, or for those of you that are selling credit spreads right now to get a better understanding as to how to use this strategy, how to use our platform. And I will see you guys next Thursday on our Foundations of Buying